the implied path. If you go and have a look at it right now, as of tomorrow, 38 basis points of price. Now, sure, the news wires hit either 25 or 50. There's going to be chaos. Why? Well, because if it's 50, the front end needs to price in those additional 12. If it's not 50, it needs to price that out. And of course, do a whole number of other things based on the guidance given. Okay. So for the first couple of minutes, it's going to be volatile. It's going to be chaotic. It's going to be a lot of unwinding, rewinding, hedging, all sorts of crazy things going on. Okay. However, if we look a little bit further out of the rates curve, and this is the crucial part to interpret tomorrow, as of December this year, the market thinks there's about 110 basis points of cuts. In other words, that's more than 4 rate cuts priced in between over the next 3 meetings. In other words, at least 150 basis point rate cut, but markets leaning on the idea of something like a 25, 50 and 50, or you could do the other way around, go 50, 50, 25, or any number of things, 50, 25, 50. The point is that's what the market's expecting. It's expecting 250 basis point cuts over the next 3 meetings. Okay. Let's go a little step further. Let's look into March next year. By March next year, the market thinks there's 185 basis points of cuts. Okay, now think between March and now, we've got 5 meetings. Okay, so if we were to plot that out in terms of 7.5 or 8 cuts, 8 cuts divided by 5 meetings means at least 350 basis point cuts. Okay, if we go one more step further, the market thinks 225 basis point cuts between now and June. Okay, which means we've got 6 meetings, 9 cuts. Okay, so the market is pricing in 3 really big jumbo rate cuts, 350 basis point rate cuts. Okay, and that's the crucial thing to understand. The market right now is well ahead of, the market, well ahead of the Fed, particularly from the previous dot plot, but perhaps a little bit too far ahead. And this is where the opportunity is tomorrow. If the Fed comes back out tomorrow and says, look, yes, we recognize the slowing in the labor market, but okay, I mean, it's slowing, but it's not drastic. It's not something that warrants us to, panic and start, doing 125 basis point cuts in the next 3 meetings. That is going to create a significant squeeze in the markets because the pricing is that aggressive in terms of the rate cut cycle over the coming meetings. Okay, like I said to you, between now and March, 5 meetings, 8 cuts. That's a lot of rate cutting to do. Okay, that's plenty. That's 350 basis point cuts between now and March. Now, again, sure, maybe the data warrants it. Maybe the data does get worse. And that's what we need to interpret. That's what the Fed needs to guide the market to say. Either the Fed agrees with the market and doesn't push back on this, in which case the market will say, thank you, Fed, we'll maintain this pricing and we'll accept that you are going to cut as aggressively as you think. If the Fed does explicitly push back, Powell says, look, yes, it's possible 50, but right now, we want to keep our options open and we're not going to commit to anything. The market will be disappointed. Why? Because the market thinks 350 basis point cuts are coming over the next 5 meetings. Okay, so that's what I want to stress. It's a very aggressive rate cut cycle that's currently priced by the market. Okay, one more thing to pay attention to. Neutral rate's 260, right? When do we get there? Well, I can tell you right now, we're going to be at neutral rate by the end of next year. Now, that's a key question. Does the Fed think they need to get to the neutral rate by the end of next year? Because last time when we had the dot plot, the Fed thought we're going to get to neutral in only 2026 and beyond. Okay, so the market's brought forward the point at which the Fed gets that neutral rate by or by more than an entire year. Okay, and that again, when we consider that with the fact that Fed thinks inflation only returns to target next year, does that create a stickiness problem for inflation? Because if they cut very aggressively now, what's the consequence of that? Well, demand starts to come back, which means we already have sticky inflation. Does that now make inflation start to move back up towards 3% and beyond? Okay, and that's the trade-off here. You're going to cut rates, you are going to stimulate demand. And if that stimulates too much demand, ultimately, because you're cooling thing or you're creating too much stimulus, ultimately you are going to have an inflation problem down the line. Okay, and that's why the Fed could very much come out tomorrow and say, hang on a sec, guys, look, yes, we appreciate things are getting slowing quickly, but we need to calm things down because we do not want to have to raise rates again, at the start of next year or beyond because inflation is starting to accelerate again. Okay. Hopefully you're starting to understand now where the opportunity scope is. It's not 25 or 50. It's we think we're only going to cut 3 times this year, and they're going to show us that in the dot plot. They show you only 3 cuts this year. The market is in trouble. We are going to see quite a significant aggressive sell-off in a number of different markets.